Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 16th of April. I'm Daniel Lam, your host for the podcast. After our discussion on the safe haven currencies yesterday, where we're expecting some degree of strengthening, we are taking the opposite side of the currency spectrum and look at the Chinese CNY, where there's likely to be some further weakness. Now, China is likely to be allowing greater FX movements in order to regain monetary policy flexibility, to alleviate pressure on the export profitability, as well as on inflation. Now, there's much less reason why China must put the CNY stability above all. Now, previously, to maintain the CNY stability, even by tightening interbank liquidity conditions since Trump's inauguration, was primarily a bid to start trade negotiations. China hoped that even in the absence of a deal, the start of trade talks may pause any further escalation of US-China tensions. But things, of course, have turned the other way around, with tariffs at extreme levels and highly restrictive for any direct US-China bilateral trade to still happen. As such, the focus on China's FX policy has now moved towards domestic stimulus, as the worst-case scenario for external demand is playing out, with neither side likely to be backing off in the foreseeable future. However, the base case is a measured depreciation of the CNY, rather than a one-off and aggressive devaluation. Gaining material export competitiveness in order to offset tariff imposition is unlikely to be the goal, because first of all, US tariffs are now too high to be possibly offset by FX devaluation. And secondly, it is China's desire to deepen trade relations with the rest of the world. Now, the second point is especially important because some of China's trading partners in the rest of the world would also be wary in protecting their own goods. There's also the possibility that when the US is making individual and bespoke deals with these countries, that the US may encourage them to be putting on tariff on Chinese goods in return for a better deal. Therefore, China, in order to build a goodwill with its trading partners, would not be so likely to be engaged in aggressive devaluation of the CNY. China will likely further open up its domestic markets, lowering import tariffs to the rest of the world, which it has already been doing since 2017, and increasing imports from the rest of the world in order to forge closer economic integration with its trading partners. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.